Today I'm very bullish on REITs and I'm buying a lot of them because they essentially allow me to buy real estate that's professionally managed at a large discount to its fair value. But that doesn't mean that I'm bullish on every REIT. On the contrary, there are quite a few of them that I expect to do very poorly going forward because they're either poorly managed, over-leveraged, or own troubled assets. Hey everyone, this is Yossi. I'm a CFA charter holder but not a financial advisor, so make sure to do your own research. I run a small investment firm that specializes in REIT investing, and in today's video I want to talk to you about 3 specific REITs that I would consider selling before 2024 in order to get your tax loss and move on to something else. But before I get into it, I want to let you know that we are currently running a Christmas sale for our REIT newsletter, High Yield Landlord. So if you want to access my entire portfolio, now is a great time to join us. There's also a 2-week free trial, so you have nothing to lose. So the first REIT I will consider selling is called Global Net Lease, ticker symbol GNL. This is a net lease REIT and some of its close peers are Realty Income, WP Carey and Vichy Properties. But Global Net Lease stands out in its peer group as the REIT with the worst track record. Since going public nearly 10 years ago, its share price has dropped by about 67%, even as most of its peers enjoyed significant appreciation. And even if you include dividends, shareholders are yet to earn a positive return over the past 10 years. I think that this horrible track record is the result of poor management, too much leverage, and owning troubled assets. The management has consistently issued more shares at highly dilutive prices in order to buy more properties, as that would justify higher fees and salaries for the management. For the same reason, they've also taken on a lot of debt, as this will allow them to maximize the size of their portfolio, but today they are paying the price. And then finally, because they had a relatively high cost of capital, they had to buy properties at high cap rates, which come with high risks. They end up buying a lot of single-tenant office buildings, which in today's environment probably have negative equity value in many cases, and they also bought a lot of older industrial properties that face significant vacancy and obsolescence risk, especially as the cycle turns in the coming years. The stock is cheap, of course. It's trading at about 8 times FFO and a nearly 15% dividend yield, but this is one of those stocks that always seem cheap, and yet it only gets cheaper and the company keeps underperforming over the long run. It could bounce higher in the near term as interest rates return to lower levels in 2024, but the same is true for most REITs, and therefore I wouldn't hold on to it for this reason. Instead, if I own a position, I would likely take my tax loss today and reinvest the proceeds into one of its close peers. Before I go into the second REIT, could you please do me a huge favor and click the like button? That really helped me a lot to grow this channel. Thank you so much in advance. Then the second REIT I will consider selling is called Public Storage. Its ticker symbol is PSA. Unlike Global Net Lease, Public Storage is actually a high quality REIT. It has a great management team that has one of the best track records in the entire REIT sector. It has an A-rated balance sheet. It owns high quality self-storage properties. But despite that, its share price has crashed, and as a result there are a lot of investors now who are buying the dip, thinking that they are getting a great deal. But I disagree, and in fact I would consider doing the opposite and sell my position. That's because even following the recent crash, the shares are still priced at 17 times FFO, which isn't particularly cheap, especially when you consider that the self-storage market is today overbuilt and likely to face years of stagnating same property NOI. The pandemic led to a temporary boom in demand for storage space because people suddenly needed to make space for a home office. They were also moving around from one place to another. Some even went traveling and working as digital nomads and needed a place to store all their stuff. And then a lot of the older generations unfortunately also passed away and left a lot of stuff behind. But this surge in demand was met with a boom in construction activity, and now right as this new supply hits the market, I expect the demand for storage space to normalize in the coming years as increasingly many people return back to the office. This could turn into a multi-year headwind for the entire sector, and for this reason I don't think that public storage is as cheap as it may seem. I think that there are some other property sectors that offer better growth prospects at lower valuations, and for this reason I will likely take my tax loss and reinvest elsewhere. And then finally, the third REIT that I would sell here is called Boston Properties. Its ticker symbol BXP. I wouldn't sell it because I expected it to crash. I don't think it's going to lose you a lot of money. On the contrary, it could do quite well over the long run because the stock is cheap, it's well managed, it owns Class A office buildings which are still doing really well in today's market despite the negative perception, and the company also has a good balance sheet. But despite that, there are 2 reasons why I would sell here. The first one is that my capital is limited and I think that there are better opportunities elsewhere. A good example is Alexandria Real Estate, which is, in my opinion, a better REIT in every respect, and yet it's priced at a comparable valuation today. Alexandria has been falsely classified as an office REIT despite mostly owning life science properties, and I think that offers far better value than Boston Properties, and so here you need to ask yourself, why would you buy shares of Boston Properties instead of Alexandria? And secondly, I fear that the fundamentals of the company won't matter as much as the perception of the market for years to come. I fear that we're going to see a repeat of what happened to Simon Property Group about 5 years ago. Back then, its valuation was cheap, its fundamentals were strong, but because malls were hated, the stock of the company turned into a value trap. I fear that Boston Properties is going to face the same outcome in the coming years because the office property sector is hated, and I don't see that changing anytime soon. Now, if you want to access my entire real money REIT portfolio, feel free to join High Yield Landlord, my REIT newsletter, for a 2-week free trial. We are currently offering a Christmas sale, as I said earlier in this video. I'll put a link to it in the description of this video. And finally, if you thought that this information was valuable, I would really appreciate it if you could click the like button of the video. That really helped me a lot to grow this channel. Thank you so much in advance, and see you at my next one. Bye bye.